All right, what is up, tycoons? What's up, traders? Super excited for today's video. If you're like me and watching this video, you're probably interested in natural gas because it is in the sub $2 price levels. Now, the reason that this has my interest is because if we take a look at the chart here, and this is the Henry Hub natural gas spot price, we can see that for periods of time, the price has dipped below $2, but it has not stayed there very long. Now, depending on your time frame will define exactly what very long is, but let me show you guys what I mean. All right, so in this time period here, natural gas was below $2 back in the 90s for about 1 year, okay, around 334 days. And then afterwards, it skyrocketed up afterwards. Now here in the early 2000s, it stayed below $2 for about 150 days, trading in that range, in that sub $2 price level. All right. Now over here in the 2016s, we can see that natural gas was below there for about 245 days. And over here recently in 2020, largely due to the pandemic, the price of natural gas was trading below $2 for about 336 days. So you can see that from about a half a year to a year, natural gas does go below $2 and can stay and consolidate within those prices. Now, just because it's done that historically and rebounded afterwards does not mean that it has to do that. But if that pattern tends to repeat itself, this could be the beginning stages of natural gas really consolidating for a half a year to a year before we see some type of a rebound and getting back above that $2 price range. So that's why I'm really interested in it. I just wanted to show you guys this chart before we hop into the video. Make sure to smash the like button and subscribe to the channel. In today's video, what we're actually going to be doing is going over some different option strategies that you guys can use when trading and looking to trade natural gas. There's a lot more that you can do besides just buying UNG shares or just buying BOIL shares. Now, the option strategies in this video will work for BOIL. They'll work for UNG. So, you can trade whichever one you want to use when it comes to the ticker symbol. But for the sake of this video and due to the amount of requests, we're going to cover the strategies on BOIL. Okay, so we're going to hop on to the next slide here. And the first thing we're going to talk about is selling cash secured puts. I'll go over what this is if you're not familiar, but please remember, all this is simply showing you guys some of the different strategies out there. All right. It's not financial advice, but rather just going over some of the different ways that you can still make money off of UNG or BOIL without having to buy or sell just the stocks. So this first one obviously is the selling the cash secured puts. If you're not familiar with this term, a put contract is an option to buy 100 shares of a contract at the given price strike that you choose. So what that means that is if you sell a cash secured put, you need to have enough cash in your account to purchase the 100 shares at the strike price that you're choosing. So in this case, in our first example here, we actually have chosen the $3 strike price. So this means that we need to have $300 in the account by May 19th, 2023, because if BOIL is trading below $3 a share, we're going to be forced to purchase 100 shares at $3 a share. Right. And so what you do is if you sell this cash secured put, you actually get a credit of $45. Now, depending on your broker, this is Thinkorswim that this is all these screenshots are taken from. You will have to pay commissions on your option trades. Now, if you're using something like Robinhood, then you may not have to pay commissions on those, right? But keep in mind the commissions as well when you're factoring in some of these things. So if we go and break down this right here, this is the May 19th, 2023 contract. And if we were to sell the 3 put at the time of this recording, when we made this, it was $45. You would get a $45 credit. So if you subtract that $45 from $300, you're left with your max loss, which is going to be $255. And this would basically mean this is like the most money you can lose on the option contract. But another way to think of it, okay, is let's say you actually want to buy BOIL at $3 a share and you don't want to pay above it. Now, you're comfortable buying BOIL if it goes below $3 a share, no matter what, you just want to get in at $3. Well, if you actually sell this cash secured put, your average cost per share is going to be $2.55 per share because you collected $45 in premium selling the put contract. Now, I know these options can be a little confusing, but hopefully this is starting to make sense. And, the price of these options will fluctuate based on, the expiration date and the strike that you choose. Now, the next one, if you take a look here, this is the April 23rd, April 21st, 2023, 2.5 put. And if you sell one of these, you can get a credit of $10. And so what this means is by April 21st, if Boyle is trading at $2.50 or below $2.50 a share, you're going to be forced to purchase 100 shares at $2.50 a share. But you collected $10 in premium, so you actually would own the shares at about $2.40 per share, rather than just a $2.5 per share. So it's a really nice way to kind of choose and pick what price you want to own a stock at, and also get paid in the meantime while you wait for that price to come. So, depending on your risk, you choose the ones that are farther out of the money, which mean they're farther away from the current price. 2.5 is farther away than the 3 strike. And you can see that this one is May. It has more time on it than April. So the more time and the closer you are to the strike, the higher the amount of premium that you can collect by selling cash secured puts. Now, if you go really far out in time, all right, this is the January 19th, 2024 expiration, and you can collect $60 in premium if you sell these cash secured puts. And what that would mean is that if they were forced to be executed, you would actually own Boyle at around $1.40 per share, and you would have 100 shares if these option contracts were to get executed. So a good way to look at this is not only can you choose the strike price that you want and get paid a little bit to own it, but you can also, if it never goes down to those price levels, you just get to collect that premium, right? So if by April 21st of 2023, you get to collect that $10. And if Boyle is not below $2.50, you just keep that straight in your pocket and the contract expires worthless. And then you can rinse and repeat the process, and you can continue to sell cash secured puts on a stock, in particular Boyle or UNG for the sake of this video, at prices that you want to own them at. And until those option contracts get executed, you can collect the premium for free. All you have to do is put up the collateral necessary to actually purchase those 100 shares at the given strike price. Now, remember, the closer the strike price is to the current price of Boyle, the more premium you're going to get, as well as the farther out the expiration date is, the more premium you're going to get. But, for instance, if you wanted to buy 100 shares of Boyle at $2 or below in January of 2024, you could sell these cash secured puts and you would collect $60 off basically $200 worth of collateral, which is a really nice return. And what it does is it lets you just sit there and wait until January of 2024 and see if Boyle is going to be below $2 or not, right? So that's one of the strategies. Another one is going to be debit spreads, right? And these are going to be vertical call debit spreads. Call debit spreads are bullish. And what you're doing is you're buying a more expensive option and then selling a cheaper option, right? So you're going to buy one that's a closer strike. So the strike is closer to where Boyle is at. And then you're going to sell the one with a farther strike. And so the examples that I've shown here, what we have is we have the January 2025. So that means that these contracts expire in about 2 years, right? And they cost about $40 per contract. So your max loss is going to be the cost of those contracts plus your commissions, right? So this one, it costs $40. And the max profit on it is $460. So this is a 10x. If you think Boyle is going to be above $15 because you're buying and selling the 10 and 15 strike. So in order for these to get the max profit, Boyle would need to be above the contract that you're selling, the 15. So if you think Boyle is going to be above $15 by the year, January 2025, then you can purchase this option contract and you would get a max profit of $460 at a cost of $40. Now, Boyle would roughly need to 2 or 3x to get to those prices. But you can see that through the power of options, your max profit is actually a 10x play. So, that's something to keep in mind, right? And of course, as you adjust the strike prices, things will adjust as well. If you take a look here, this is the January 2024 expiration. We're buying the 10 strike, selling the 11 strike call. And this one costs $25, and this gives you a max profit of $75. So this is about a 300% play with a max profit of 300%, and they're very cheap, right? Because you're buying and selling an option. So, the first one only costs $40 per contract. The second one costs $25 per contract. If we take a look here at the January 2024 19 and 20 call debit spread, those cost about $10 per contract, and the max profit is going to be $90 per contract. So that is roughly a 900% max profit there, maybe 800%. Okay. And here we can take a look at the January 2025, buying the 25 strike and selling the 30 strike calls. And those cost about $35 per contract and a max profit of $465. So, there's multiple different ways. And one of my favorite things about spreads in particular is that they help reduce volatility and time decay. All right. There is the option Greek letters. There's Vega and there's also Theta. Theta stands for time decay and Vega stands for volatility decay. And whenever you buy or sell an option contract, Vega and Theta, move the price, right? And so typically time decay and theta will eat away at the price of your call options if you're buying a call option. But if you sell a call option and you buy a call option, what you're doing is you're locking in your theta and your vega, right? And so you're reducing the amount of theta and the amount of vega, because let's say you bought one call option that has a 0.5 vega, right? And then you sold the other option contract that has a 0.3 vega. So, now you're minimizing the vega and the theta by doing so. And it's a good way to kind of help reduce risk and volatility by doing these call debit spreads and selling an option versus just only buying a naked call option. Now, one thing I want you guys to keep in mind is, remember, you get to keep this credit whenever you sell a cash secured put. So this $45 right here that you get to keep, all right, that goes instantly to your account. If you wanted to, you could, in essence, use the money collected from that to purchase this call debit spread, right? And so what you can do is you can sell a cash secured put to finance buying a call debit spread, right? And these are just some of the different ways that you can combine some of these strategies together. But as I showed you guys, you collect a $45 premium here by selling these cash secured puts, and you can purchase a debit spread here with the premium that you collected from selling those cash secured puts. So, once you start to understand these and combine these together, there's really a lot that you can do with them. Now, if you want to hedge yourself, or let's say you think that price is going to go down, you can buy bearish put debit spreads. And so a put debit spread would be very similar. And so you're going to buy a closer strike put and sell a farther strike put. All right. And this also is going to help reduce against the volatility decay as well as the theta decay. So in this case, what we have here is a vertical debit spread put that expires in May of 2023. And what you're doing is you're buying the $3 strike put and you're selling the $2 strike put. And this is going to cost you about $30, and you have a max profit of $70. So this means that if Boyle is below $2 a share in May of 2023 at the time of expiration, you're going to see a max profit of $70, and it only cost you $30. So these are kind of cheap ways that you can hedge some of your long positions. Or if you're just bearish and you're looking to get into some bearish positions and take a bearish option strategy, put debit spreads are one that you can consider. Now, just like the others, the farther you go out in time, the more that you can basically, it's going to cost, right? And so here we have the January 2024, and we have the 2 strike and the 1 strike. So we're buying the 2 strike, selling the 1 strike, and that costs about $50, and you can get a max profit of $50. So if you think that Boyle could be below $1 by January of 2024, what you could do is you could buy this put debit spread, and this would give you an option hedge or give you, basically bearish, premium. Okay. And you can make money if Boyle is below $1 by January of 2024. Now, I highly recommend watching some of these other videos that I've made concerning natural gas, especially this one right here. There's a lot of questions about the decay involved with investing in Boyle. There's also some decay associated with UNG. I have a really great video. This is the thumbnail and title, going into and explaining very well the dangers and myths of investing in Boyle and UNG, so regarding the decay. And I also have a separate video called the top trading strategies for natural gas right here. This is the thumbnail and title. And in this video, I go over multiple different strategies that you can use, such as moving averages, the Fibonacci's, supply and demand zone, Bollinger Bands, many other things that work on small time frames for day trading, as well as large time frames for swing trading. And it's a complete video that goes over many different things and goes over, multiple different strategies that you guys can look and try to see which ones might help you out, or which ones you may be interested in if you're looking for some different strategies to possibly trade natural gas with. And the last one I want to recommend to you guys is this video here on option hedges that goes into more detail of really how to protect yourself and protect your portfolio by using option hedges. And it goes over some examples rather than just showing you guys the strategies that I'm showing you guys now of, what a put debit spread is. We actually really dive into, the performance and how you can really hedge yourself some more in depth. So if you're underwater on Boyle or you're underwater on UNG and you don't have any hedges, that video is definitely going to be a good watch. So that way you can learn a little bit about how you can use options to hedge yourself. Now, some bearish option strategies, right? So let's say, you know some of those. We went through the video, but you're still a little bit confused. There's a couple bearish option strategies that you can do. One is you can do a call credit spread. And so this would mean you are essentially selling a call spread, right? So we talked about selling cash secured puts and buying vertical call debit spreads. Well, you can actually sell call credit spreads too as well. And you're basically betting that price is going to go down, not above your strike prices that you choose for the call debit spread. And over here, we have the put debit spread, which I explained to you guys here briefly just a while ago. And you're basically betting on the price to go down, right? And that's what you're looking for, is for the price to go down. So those are some of the bearish option strategies that you can do. Some of the bullish ones is you can do a put credit spread. And so rather than buying a put debit spread, what you would do is you would sell a put spread, and that would become a credit. So you would do a put credit spread, and you would be betting that the price is going to go up and stay above, the strikes that you choose on your credit spread, and you get to collect that premium. And the other one is the call debit spread, where you're going to be buying some call options, buying one and selling one as well, and betting that the stock is going to go up. All right. Now, when it comes to credit spread versus debit spread, we have a nice little, presentation right here that kind of helps explain some of the advantages and disadvantages. So in a credit spread, investors sell a higher premium option and buys a lower premium option. And premium is just fancy words for dollar amount. Okay. So you're buying a more expensive option, and or you're selling a more expensive option, and then you're buying a lower price option in a credit spread. Now, the advantages of that is there's less margin requirement, it's more versatile, and you can reduce risk if price moves against your expectation. The disadvantages is that the long option investment reduces your profit potential, and commission is more than a single uncovered option, right? And that would be basically just a naked option, right? Where you're not doing a spread and buying and selling one, you're just simply buying or selling simply one of them. So you're going to pay more fees on commissions because you're doing 2 option contracts per each spread. Now, in a debit spread, investors buy a higher premium option and sell a lower premium option. Some of the advantages of this is that it does not require trading on margin. You can get a higher return in moderate price changes, and it allows investors to plan their trade. The disadvantages is there's a limit on the volume of profit, the initial cash outflow could be higher, and the expected price movement could reduce profit. And so here we kind of have another chart to help, visualize some of this stuff. But if you're bearish, right, one of the plays that you could do is sell a call credit spread. Now, you want to do this when there is a high IV rank. IV stands for implied volatility, right? And so this chart down here shows you guys pretty well, right? So for a credit spread, you can see that the stock ran up and the price is elevated. And then there's also high implied volatility, IV. And so what you would be doing is selling a credit spread somewhere up here in this region and betting on the price to go down. That's when you would be selling a credit spread, right? And so with the low IV rank, you'd be looking for a put debit spread or a call debit spread, right? And so in this case, you can see here, price is low and starting to rise. And then you also have implied volatility rising. That's when you would want to get into a call debit spread, okay? So, implied volatility, I spoke about Vega earlier. That's something else that you want to consider, just when you're doing some of these strategies, right? If the volatility level is really high and prices are really high, then you can collect a decent premium selling options. And if volatility is low and prices are low, then you can, then you can basically get into options for cheaper that way. All right. So that's one way to think of it. Now, I mentioned cash secured puts and how you can use these to finance, some of your call debit spreads, but you can also sell naked call options, right? And so if you own 100 shares or more, you can actually collect premium to help reduce some of the volatility decay that you're experiencing on your shares. So in this case, what we have here is we are selling the, what strike is this real quick? We're selling the $10 strike that expires in June of 2023, and you're collecting $20, right? And so what this means is that if BOIL is above $10 per share by June 16th of 2023, you're going to be forced to sell your 100 shares at $10 per share. But for doing so, you get to collect $20 in premium, right? So for every $100 or every 100 shares you have, you can sell option contracts that fit, your price targets and your risk level at a good expiration, and, just collect some money essentially for doing so. Now, remember, the more time you add on these expirations, if you go out to the January of 2024 strike or expiration date and you sell the 10 call, you can collect $120 for every 100 shares that you own. All right. So, if you're in, let's say you buy into BOIL shares at $3 a share, okay? And then you sell the $10 strike price that expires in 2024 for a $120 credit. Now your average price per share is actually going to be $180 because you already collected $120. And if BOIL's above $10 per share, you're going to be forced to sell those 100 shares at $10 by January 19th of 2024. But your total cost for those shares were actually around $180 a piece. So that's a really, really big return on your investment. Now, again, these are all just examples. I'm not telling anybody to do any of these specific strategies, sell any one of these or buy any one of these. Rather just giving you guys some real life examples of, the different prices according to, the strikes, the premium, and what the different strategies are. Now, we also mentioned selling credit spreads, right? And so what you can do is you can sell credit spreads if you don't think that BOIL is going to go above the strike price to collect premium while things go on. If you look at the April 21st, 2023 strike and expiration with a strike of 5 and 5.5, you can collect $10, right? And this is going to cost you about $50 in premium. So that's about a 20% return on your capital that you need, to actually sell the credit spread, right? So, you need $50. And if you have that $50, you can collect $10 in premium. And as long as BOIL is below $5.5 a share, then you get to collect that premium, right? So whenever you're selling a call credit spread, all right, you want the price to be below your strike prices, right? So we want it to be below $5. We want it to be below 5.5, and we can collect that premium and keep it. If BOIL is above $5.5 a share by the time of this expiration, then it's going to cost you $40, and that's going to be your maximum loss. Okay. Now here you can take a look, and we're selling the June 16, 2023 credit spreads with the 11 strike and the 12 strike, and you can collect about $5 of premium. And you can see here that the max loss is $95. So it'll take about $100 in collateral. You can collect $5 in premium. And if Boyle is above $12 a share, all right, at the time of expiration, then that's how you're going to see your max loss there, and you're going to lose about $95. So it's really important to choose things wisely and really, do some of your own research and dive into these a lot more before you just jump in blindly, right? So, I mean, only getting $5 of premium and risking $95 of a max loss is not that favorable, right? I mean, those aren't good odds that you wouldn't want to take unless you're extremely confident that Boyle is going to be below $12 a share by June 16th of 2023. If it's below $11 and $12, then you get to just collect that premium and go ahead and, just keep that cash. So that's it for today's video. Not too much of a technical analysis video on natural gas, but more of some of the different option strategies that you guys can use. Hopefully you learned something new. Be sure to check out those other videos that I posted in here as well, such as the option hedging and how to hedge yourself with options, such as the different natural gas trading strategies that you can use, and definitely the video about the decay and the myths surrounding Boyle and UNG.